Hello guys, welcome back to another video tutorial for the beginner series in Forex trading. This is lesson 6. So on this one we're going to be talking about types of orders, the kind of orders we use in the Forex market. So these orders are the way we take our trades in the market. So the first one is market order, also known as instant execution. So this one is also known as instant execution. So what kind of order is this? So this is an order to buy or sell at the best market price available or at the best available price. So this market order or instant execution, it's like just going into the market. Let's say the market is at a good level you want. You could just open a trade immediately. You just say buy and sell, or you sell. That's kind of like instant execution. So for example, if the bid price of EURJPY is currently at 1.2140 and the ask price is at 1.2142. So if you want to buy EURJPY at market price, that's the current price, then it will be sold to you at the ask price, which is this one. If you want to buy, you're going to use this price and 1.2142. So once you just click buy, your trading platform will instantly execute a buy order at the exact price. So once the market is just floating and you want to take a trade, most of the time that's what I use. I use instant execution because I watch the market. Sometimes it gets to my regions I want to buy or sell, and I just take buy or sell. So even if you're following some trade signals, they are going to be telling you the kind of orders to use in the market. Is instant execution or limit order. And that's going to take us to the next one, which is called limit entry order. So this kind of market order is an order that you place to buy below the market or you sell above the market at a certain price. So limit order is like saying that if the market is trading like this now, if I want to sell and I don't want to sell here, I want the market to come here, I'm going to place a limit order at this price. Let's say the price could be 1.5050. So until the market gets to that level, my trade will not be triggered. So but once the market gets there, automatically my broker is going to put my trade live into the market, and then my trade will start running. You see? So that's what we call limit order. You're selling above the market, and if you're buying, you're going to place a level, your order below the market price. The market comes down there, it triggers you, and the market starts buying. If you're in the right direction, fine, your trade automatically goes in profit. So for example, if EURUSD is currently at 1.2050, you want to go short, you want to sell EURUSD. If the price reaches, you want to sell if the price reaches 1.2070. So you could either sit in front of your computer. It depends on how long the market is going to take to get there, or you can be checking the market intervally at maybe 1 hour 30 minutes. You can be coming to the market in 30 minutes interval or 1 hour, so you can catch it when it gets there. So but for you not to miss it, all right, you can wait till it gets there and you can use that instant execution, the first one, to just take the trade. But for you not to miss it, or if you can't be looking at the computer, you can sell with a limit order at that price 1.2070, and then you could walk away from your computer and then attend to other things. If the market gets to the level, just like I said, your trade is going to go live into the market. But make sure you're going to use your stop. You put a stop loss so that in case the market goes against you, you wouldn't lose more than you expected. Alright, so that's that for limit order. So you could call this, you could say buy limit or sell limits. It depends on what you want to do. So you have to know the market direction you want to take, and that's that for the limit orders. The next one is stop entry order. Stop entry order is like opposite of limit entry order. So this one is that this order you buy above the market price and you sell below the market price. Let's say for instance the market is trading down. I want to sell this market when it gets here. I'm going to use buy stop. I'm going to use sell stop order. All right. I'm going to use sell stop. I'm selling below market price. So if the market hits this level, my trade is going to trigger and I'm going to sell it. We use this kind of market execution or market order once in a while. I don't think so many people hardly use it, but some people they find it best. Let's say you have a level here. Let's say some people that use support and resistance, they might have a level here, and they will say if the market breaks that support level, that means the market is going to sell. So they might just put a sell stop there. Once the market goes below the level, automatically that means the market is going to ride for long. So that's when they use that sell stop. And the same thing for buyers. Let's say you have a level here of resistance and you're expecting the market to break it. The market breaks it and you're sure it's going to keep on buying. You could put a buy stop order above here. So once you put the buy stop and let's say this is the level the market is trading here, you can put buy stop at 1.2050. Make sure you set your stop loss at the same time. So once the market breaks through that level, it triggers your trade and you believe that the market is going to keep on buying. All right, so that's that for uh, buy stop and sell stop. That's the explanation there too I just made. You can read through that. All right, the next market order is a stop loss order. This one is kind of like, it's not really like a trade order, but it's very important. Every trade you take in the markets must have a stop loss. So if you're taking a trade now at the market price, they're going to ask you your TP and SL. So your stop loss is where you want is the price or a level that you want the market to get to and stop you out. That means if I buy and I'll put my stop loss here. If I buy here, I'll put my stop loss down, I'll put my take profits up. So if the market is buying, I'll be in profit. If the market starts selling to this point, it should take me out, because if it keeps on going down, I'm going to be losing more money than I plan to lose. So you don't want to blow your account, you don't want to risk it, because you can't be sitting on your computer to be watching if the market is not going against you. So for you just to be safe, you put your stop loss and then you can take your eyes away from the chart. Forex is not a 24 hours thing. You sit on your computer and be watching the market. No, you don't trade forex like that. So the time I'm recording this video, I took a trade yesterday, and while the trade was running, I was sleeping. I just put my take profit and stop loss, and everything was just good. I don't need to edit anything. You can't move the market, you can't control the market. It's just to take your trades and allow the market do what it wants to do. So stop loss order is a type of order linked to a trade, all right, for the purpose of preventing additional losses. So if price goes against you, that's what it means. If you take a trade and the market is going against you, your stop loss order is going to take you out. It's going to say, hey, I don't want to lose more than this, so I'm going to stop here. So remember, this type of order is very, very important. One of the most important things that you have to have in your trade. So the stop loss order remains in effect until the position is liquidated, or you can cancel the stop loss order. Let's say the market is running, this is your take profit and this is your stop loss. So your stop loss will always be there, but let's say if the market is getting close to your take profit, you can take out your stop loss and say, okay, the market will hit my take profit. That's when you can take it. But most of the time, you don't need to, or you could bring it. There's what we call break even. All right, there's what we call break even. If the market is running in my direction and is almost getting to my profit target, I'm going to move my stop loss order above my entry price. Let's say if I buy here, I'm going to move my stop loss order a little bit above my entry price. So that means I'm on break even. If the market should fall down and hit my stop loss, I'm not losing anything. I might even close with small, tiny profit or small partial profit. So learn that if the market is going in your direction, is almost getting to your take profit, take your stop loss to your entry or a little bit above your entry. If it's for sell, the market is selling, your stop loss is up. That means if the market start buying, you're going to lose. The market should stop you out at that level. But if this is your take profits and the market is almost there, you can take your stop loss down to this point. So that means you're no more losing anything. If the market goes against you, you're not losing anything. It's below your uh, entry price already. So that's how we use the stop loss. So for example, if you bought Euro USD at 1.2230, now to limit your maximum loss, all right, you set a stop loss order at 1.2000. That means this is like 30 pips. This is like 30 pips from this price to this price. That means if you buy here at 1.2230, your stop loss is 1.2200. That means below market price, below your entry. That's your stop loss, SL. And then instead of moving your instead of moving up your trade, your trading your trading platform would automatically execute a sell order at 1.220, 1.2200. That's the best available price to close out your position for a 30 pips loss. So instead of the market to go in your direction, the market tends to sell. Once it hits this your stop loss level, automatically your broker is just going to close your trade for you. You don't need to do anything. Your broker is just going to close the trade for you and protect your remaining capital. But if you don't put your stop loss, the market could still be running, and you know, as it's running, you're losing more. Your losses are increasing. So stop loss is very, very important. It's better to have a stop loss in a trade and not to have a TP. Some people, they take a trade, they just put TP, but they don't put stop loss, which is very wrong. It's best you have a stop loss, and then you might leave your TP open in case the market is running in your direction and you don't have a take profit. If you come back to your chart, you might see the market still running in your direction. That's fair. But you don't want to risk it by taking a trade without a stop loss. So many traders have lost their accounts. So many traders have taken a lot of losses without putting a stop loss. And now let me say this too. It's very important. Never you shift your stop loss. You're going to learn it the hard way. You're going to learn it the hard way. So many traders, they struggle with the ability to accept small losses, and that's why so many people lose money in the forex market. They struggle to accept small losses, whereby they can't just say, okay, I'm wrong, and the market just takes their stop loss and they continue the next day. If the market is getting close to their stop loss, they're going to drag it down again. They're going to edit it and shift it a little bit lower, and the market might still be going down, and they're still going to be dragging it. Please don't do it. I've seen people that do that, and their losses went beyond recoverable. So you don't want to do that. If the market is getting to your stop loss, accept it. The day you're going to take a good trade is going to run in your direction too. You're going to make money, but never you shift your stop loss. All right. So you should know where you to enter your trade. If you're in the right direction, the market should support you. All right. And if you're wrong, the market could just hit you out. And the day you're right, you're going to make profit. Okay. So that's that. So never you shift your stop loss, except you're using profit and you're bringing it back to break even. That's when I could advise you shift your stop loss. So stop losses are extremely useful if you don't want to sit in front of your monitor, or they worried about your trade, or worried that you will lose all your money. So you can just simply set a stop loss order on any open position, so you won't miss your basket fishing class or elephant polo game. That's just a comic line. All right. So the next one is trailing stop. Now, what is trailing stop? So trailing stop is like another stop loss order that runs with the market. So a trailing stop is a type of stop loss order attached to a trade that moves as price fluctuates. So let's say you have decided to sell USDJPY at 90.80 with a trailing stop of 20 pips. So this means that your original stop loss is 91.00. So that means if the market goes higher, since you're selling, if the market goes higher to 91.00, you'll be stopped out. So, but if price goes down and hits 90.50, your trailing stop would move down to 90.70. So, like if the market is going in your direction, your stop loss is going to be going with it. Your stop loss is going to be going with it. If the market is going, your stop loss is going to be following it. That's trailing stop automatically. All right. So that's how we use trailing. I think, but most of the time, so many people don't use trailing stop, except the trade is already close to their take profit. All right. So you could read more about that, but that's the idea for trailing stop. I use basically stop loss. I don't trail my stops because sometimes the market could still stop you and go your direction. All right. Whether that's all those are generic, we don't need all those things. Like I said, we're giving you straight to the meat, the right information. All right. So just a few things before I go over to the next one. I would advise you to never trade real money. All right, don't trade real money now until you have learned how to trade. Demo your way to success, just like they said. As I'm teaching you now, I'm going to be teaching you how to create a demo account, how to start testing your trading abilities and your trading skills on a demo account. But we haven't got to that level, so we're going to learn about the analysis and the kind of charts we use in Forex. But demo your way to success. Don't rush to start trading real money in Forex. You might lose your invested capital. And then Forex is not a get rich quick scheme. Please just be aware. Forex is not a get rich quick scheme. It's a get rich slow process. It's a get rich slow business. So, and Forex is a skill that takes time to master. You need to take your time to learn Forex. Uh, you don't just come today and start making money. At least your learning stage to be about could be minimum 3 to 6 months. You have to be looking at the markets, trying to understand how it works. But once it starts paying you, it could cover you. It could cover the money you could make for a whole year with your job. You can make it in one month in the market in Forex. So it takes a lot of time, practice, and experience to master. Once you get that, just few months, you can make all the money you've been waiting to or you've been looking for. So all Forex traders lose money one time or the other. Most of the time at our beginning stage, we lose some money or we lose some trade. It's very normal to lose trade in Forex market. All right, you don't need to be a perfectionist. There are sometimes you can take a trade. We are all human beings. We could see the market wrongly. Okay, we could see the market wrongly, and that's why I say accept the small loss. Don't start shifting your stop loss trying to avoid being wrong. It's very very wrong to. It's a very very bad thing to do in this business. So you can't be perfect, 100% correct every time. All right. So accept small losses. Anytime you're in the right direction, you keep on winning, and your money is going to keep on increasing once you're in the right direction. All right. So that's all for the market orders. So now we are ready to go into the real thing. We're making progress. On the next one, I'm going to be talking about the Forex market analysis. How do we analyze the Forex market? So hope you find this one insightful. I'll see you on the next video.